Welcome to the Deconstructionist Deep Dive.
The podcast that doesn't just accept the story.
We break it
We examine the pieces.
and expose the machinery inside.
Let's dive in.
Today we are asking a foundational, maybe even antagonistic question.
What if everything about the AI revolution isn't just wrong, but is designed to be wrong?
Yeah. You, our listeners, sent us just an overwhelming stack of source material. We're talking pitch decks, technical papers, VC manifestos, endless thought leadership pieces, all pushing this narrative of a breakneck AI economy.
And if you just listen to that surface story, you'd think, okay, this is some kind of chaotic, democratized gold rush, right? Anyone can play.
But when we actually sat down and dissected those sources piece by piece, what emerged was, well, it was chillingly coherent.
It's not chaos at all. It looks much more like a meticulously planned corporate roadmap.
Exactly, dressed up in the language of liberation, of disruption.
But the terms they use, disruption, unfair advantage, even terms like operator, they start to look less like descriptions and more like an ideological shield.
So our mission today, we're going to tear that shield down. We plan to map out the true power structure here.
What the sources seem to point to as a kind of AI power triad.
Right. We'll look at the structural relationship between the infrastructure providers, the capital allocators, and the labor, the people actually building things.
And show how this idea of platform dependence, it isn't just emerging naturally, it seems engineered.
Engineered not as a shortcut to success, maybe, but as the primary engine for extracting value.
So if you're an entrepreneur, a developer, anyone building in this space,
Or even just someone trying to figure out where all the money and value is actually going.
then this deep dive is, we think, pretty crucial.
We're aiming to give you the cognitive framework, the map, to see the matrix you might be operating within. Okay, let's really dig into this. Let's unpack this core theoretical framework that seemed to underpin, really, the entire stack of sources we looked at.
To really understand the game, you first have to identify the players, and maybe more importantly, their structural roles.
Roles within what the sources effectively define as this AI power triad.
Right. And this structure, it seems to dictate almost everything else.
Yeah, it explains why some AI applications need to scale effortlessly, while others just hit these invisible walls.
Often right at the moment they start getting traction, start becoming profitable.
It suggests this isn't really a level playing field of opportunity. It's more like a proprietary, deliberately structured economic architecture.
Okay, so let's start at the top. Layer one, the infrastructure. The sources basically label them the landlord.
And we're talking about the big names here, right? OpenAI, Microsoft, Google, the major cloud providers.
Exactly. And why landlords? Because they control the fundamental means of production in this new economy.
The computational means of production.
Yes. Compute resources, access to the most powerful proprietary APIs. That's the ground everything else is built on.
That distinction feels really essential. It's not just that they offer a service like, say, electricity.
No, it's more fundamental. They control access to the core intelligence, the inference capability itself. And often it's proprietary.
In the age of AI, compute and that API access, it really is the new oil, isn't it?
It is. And by controlling that access layer, they exert this profound influence over every single business built on top.
They get to decide the technical limits, the speed, the features.
And crucially, the cost structure for every single player down the stack.
So if you're the landlord, what do?
You collect rent, cognitive rent, as some sources called it.
And that rent isn't really negotiable, is it? It scales directly with the tenant's success.
Pretty much. They own the digital land upon which everyone else is trying to build their, application skyscraper.
Okay, so that's layer one, the landlord.
Right.
Moving down the stack, we hit layer two, the capital. The sources called them the extractor.
Right. This is your venture capital, your private equity.
And their function. They're described as the extractive allocators.
Their power isn't in building the product itself, but in defining what value even means in this ecosystem.
They set the metrics for success, right?
Oh.
What counts as good growth? What's the acceptable path to massive scale?
Exactly. And by doing that, they determine who gets funded, who's seen as financially viable, and who isn't.
They're the gatekeepers controlling the flow of fuel, the money, into this whole system.
And ensuring, usually, that the investments align with their ultimate goal.
Which is typically high returns, often through an exit. Maybe an acquisition by one of those layer one landlords?
It creates a very specific kind of feedback loop.
Okay, landlord, extractor. That brings us to layer three, the labor, or, as the sources starkly put it, the settler.
And this is you, if you're the founder, the developer team, the entrepreneur, actually building the AI application.
You're positioned as the voluntary settler, building potentially incredible, valuable applications.
But on land, you fundamentally do not own.
And often financed by funds, the extractors, who heavily influence, if not control, your exit trajectory.
The sources paint a pretty stark picture here. The settler is doing the work, executing the vision, putting in the effort.
But you don't own the ground beneath your digital feet. And you don't get to define the rules of the market you're in.
This nested dependency settler builds on landlord's API, funded by the extractor that seems to be the core engine of value extraction identified in the material.
So, okay, if you're a seller, you need a map, right? You need to know where you can even try to build.
And the sources provide one. It's called the vertical versus horizontal solution matrix.
And this map, it doesn't just show opportunities. It kind of shows how the system keeps you contained.
Let's look at the horizontal plays first. These are the really high-stakes gambles.
Trying to build another platform or infrastructure layer yourself, maybe? Like a tool that orchestrates different AI models.
Exactly. Or a new kind of developer environment for AI. You're aiming high, sort of challenging layer one, even if indirectly.
But the risk here is described as almost total. They call it platform capture.
Right. Let's say you build an amazing tool that wrangles 5 major LLMs beautifully. What stops OpenAI or Microsoft or Google
from just rolling that exact same functionality into their next core API update?
And boom, your business is suddenly redundant, maybe overnight.
Layer 1 holds the ultimate veto power over these horizontal plays. It's like the classic innovator's dilemma.
Except the incumbents, the landlords, have almost infinite resources and they control your essential inputs. That's a tough spot.
So that structural pressure, it pushes the vast majority of Layer 3 settlers towards vertical plays.
These are the more specialized, industry-specific applications. Think AI for niche medical billing analysis or AI for high-end legal document discovery.
Things that require deep domain knowledge.
Yes. And they are more defensible, but that defensibility comes from specific data, complex workflows within that niche.
You gain some protection, a moat.
But you sacrifice broad market size and that kind of explosive scalability that Layer 2 often demands.
You're building a really nice castle, but it's in a relatively small valley.
Which, ironically, might make you a more predictable, digestible, high-margin acquisition target down the line.
Maybe for Layer 2's portfolio to consolidate, or even for a Layer 1 strategic purchase to fill a gap in their offerings.
So you're still sort of playing within their defined boundaries.
And underpinning this whole strategic map, this whole rigged game, maybe, is what the sources identify as the really toxic core of the entrepreneurial marketing.
Ah, the unfair advantage doctrine.
Yes. This phrase is everywhere, isn't it? In pitch decks, in VC blogs.
It's where the structural reality gets completely flipped, or at least obscured.
This doctrine takes complex, often unearned structural advantages, like, say, already having access to a decade of proprietary training data.
Or maybe just starting with a $500 million balance sheet from a previous exit.
Or just having a Rolodex full of Layer 2 extractor partners ready to fund you.
And it reframes all of that as personal genius. Or relentless hustle. Grit.
It's presented as, I'm succeeding because I am exceptionally clever and I work 120 hours a week.
Which might be true, the working hard part.
But it completely ignores the systemic advantages. It's the ultimate, maybe, gaslighting of the creative class, as one source put it.
And this narrative is crucial for the system to function smoothly.
Because it obscures the advantages dictated by the triad that the landlords control, the extractor's capital.
So when a settler inevitably fails, maybe due to that platform risk we talked about, or hitting a scalability limit imposed by their vertical niche,
they're encouraged to blame themselves. I didn't hustle hard enough. I didn't have the right unfair advantage.
Instead of questioning the architectural constraints put in place by the landlord and the extractor, it keeps the focus inward, on individual effort, not outward, on systemic structure.
Okay, so we've mapped out the structure, this landlord-extractor-settler triad.
The next obvious question is, well, if the constraints are potentially this visible and the power is so concentrated at the top,
why do so many smart, ambitious people still rush into that settler role? Why volunteer for potentially rented land?
That's where the rhetoric really comes into play, doesn't it? The stories they tell. Exactly. Now we need to shift from the structure of power to the rhetoric used to maintain it, to make it palatable, even desirable.
The sources detail what they call the 4 primary control mechanisms. These are the ideological tools, the narratives designed to co-opt that entrepreneurial ambition and channel it into compliance with the system.
Mechanism number one is probably the most pervasive. It's the benevolent disruption.
Ah, yes, the idea that these platforms are democratizing AI.
Precisely. It frames platform dependence, your deep critical reliance on, say, OpenAI's API for your core product functionality as democratic access.
That sounds fantastic on the surface, right? We've lowered the barriers to entry. Anyone can start an AI company now with just an API key.
And maybe they have lowered the barrier to entry, but the sources argue they've only done that to ensure the perpetual collection of
Cognitive rent. Let's get specific about that term. What does it mean in practice?
Okay, think about early AWS. The promise was similar. Pay only for what you use, scale easily. Great.
But the core difference here, the sources stress, is that the foundational capability, the LLM inference, the thinking part, is often proprietary and absolutely essential to the product. It's not just storage or basic compute.
Right. So if your settler application succeeds, if you get traction, you generate volume.
Your variable cost, the rent you paid to the landlord via API calls, rises directly in proportion.
Meaning your margins are immediately capped, or at least heavily influenced, by layer one.
Because the landlord can simply decide to increase their API pricing or change the terms of service.
And you have almost no technical recourse if your entire product, your entire value proposition is built on their specific proprietary inference layer. You're locked in.
The historical parallel drawn in the sources is really sharp here. They compare it directly to the rhetoric of the sharing economy.
Remember that. It promised entrepreneurial freedom, flexibility, be your own boss.
But what it often delivered in practice was gig labor dependency, precarity, and systematic value extraction for the platform owner, Uber, Airbnb, etc.
It's arguably the same structural mechanism playing out again. Lower the entry cost dramatically, hook people in,
Then control the means by which they generate income, ensuring you can collect rent perpetually from their effort.
Okay, so that's benevolent disruption. Control mechanism number two, the alchemical entrepreneur.
This ties right back into that unfair advantage idea and the self-blame cycle we touched on.
It does. This mechanism works by reducing these huge, complex structural realities like massive capital concentration in VC or deep regulatory moats built over years.
Down to purely individual psychological traits. It's the cult of the genius founder.
You, the founder, must be the alchemist. You have to magically turn sheer effort, anxiety, and maybe a little bit of code into billion-dollar gold.
Regardless of the actual resources or structural advantages you start with or lack.
The psychological impact here is identified as manufactured anxiety, a state of perpetual motion.
Founders feel this immense pressure, got to be building, got to be moving, raising the next round, posting updates, attending conferences.
It's constant motion designed, perhaps unconsciously, to prevent critical examination of the constraints.
You're just too busy running on the hamster wheel to notice you're inside a cage built by someone else.
And the really crucial part here is what one source called the structural omission.
Meaning?
The narrative deliberately, or at least conveniently, ignores the massive advantages conferred by Layer 2 capital flows or Layer 1's pre-existing data moats and infrastructure scale.
Why? Why omit that?
Well, think about who benefits. The VC ecosystem, Layer 2, benefits immensely by promoting this individualized fantasy.
Because if success is all about your individual genius and hustle,
Then VCs maintain their image as simply being really good pickers of that inherent genius, rather than acknowledging they control the economic levers, the fuel supply, that largely determines who gets to scale.
it shifts the focus away from their powers as allocator.
The thought leadership industry, the conference circuit, they also benefit by selling this dream, these frameworks for individual success, rather than systemic critique.
Okay, mechanism 3, the consultancy-industrial complex. This sounds ominous.
It refers to that high-margin, often opaque intermediary layer that sits between the extractor, capital, like PV firms, and the settler, the actual execution, the company being acquired or invested in.
The big consulting firms, the boutique advisors.
Exactly. They function as a kind of priestly class, as one source put it. Their job is to translate the messy reality of execution into language that the capital layer understands and finds acceptable.
They perform what the sources call risk ritualization. What does that mean?
It's not just about genuinely reducing risk. It's often about performing a high-priced, elaborate ceremony to justify large capital allocations that have often already been decided upon.
There was a specific example in the source material, wasn't there? about diligence reports.
Yes, the $600,000 to $1 million diligence reports, especially in private equity deals.
That's a lot of money for a report.
The argument is these often aren't primarily about uncovering some revolutionary hidden insight. They function more as validation ceremonies.
Meaning, the PE firm has likely already decided, we want to buy this company, or we want to make this investment.
But they need this expensive, hefty report from a prestigious consultancy, the Priest, to standardize the assessment framework.
To provide air cover, basically.
Exactly. To justify the decision to their own investors, the limited partners. The consultants are paid extremely well to package the decision, minimize the appearance of uncertainty, and essentially stamp approved on a predetermined outcome using standardized language and models.
So their power comes from what? Information asymmetry.
Partly. And their ability to speak the very specific, often jargon-filled language required for capital allocation. A language that's often deliberately kept opaque to the Layer 3 settlers who are actually building the value being assessed.
Right. Okay, final one, mechanism number 4. The operator mythos linguistic control.
This zeroes in on the language used, specifically the pervasive categorization of labor within this ecosystem, focusing on that ubiquitous term.
Operator. You hear it everywhere now. We're looking for strong operators. She's a great operator.
The sources argue this terminology is far from neutral. It's a very precise form of linguistic control.
How so?
It clearly and very cleanly distinguishes the operators, defined as the doers, the execution labor, the hands-on executives running the day-to-day.
From capital, defined as the deciders, the funders, the ones holding the financial control and setting the strategic direction.
It creates a distinct hierarchy through language.
The sources draw a direct and pretty insightful historical parallel here, which really made this click for me.
What was it?
They compare it to the historical distinction between the landed gentry and the yeoman farmers.
Ah, okay, I see that. The gentry owned the land, controlled the capital, made the big strategic decisions.
And the farmers operated the land. They did the work, managed the fields, but within the framework set by the owner.
So the argument is that the unease, the resistance that many skilled founders or executives feel when they get labeled purely as an operator.
It's an intuitive, maybe subconscious recognition of this implied subordinate status.
They're being subtly told, through language, that they are primarily there to execute someone else's vision, capital's vision, rather than being the ultimate definers of the trajectory themselves.
You're positioned as the means of production, not the owner of the strategic destiny. That language does a lot of heavy lifting. Okay, so we've broken down the structure, the triad, and we've looked at the rhetoric, the control mechanisms used to keep people playing their assigned roles.
Now, let's follow the money. Let's drill down into the actual financial plumbing of this system.
How does the value actually flow? And what's the psychological cost being exacted from the creative class, the settlers, in this process?
The most fundamental shift identified in the AI economy compared to previous tech waves seems to be architecture of value extraction itself.
And it's driven entirely by inserting Layer 1, the landlord, as this mandatory toll collector right in the middle of everything.
Right. Think about the traditional model of, say, a SaaS startup from 10 years ago. The flow was relatively straightforward, even if the outcomes were often brutal.
You had labor developers, designers, marketers creating a product.
And that product, if successful, generated revenue, which then flowed primarily back to capital, the investors and founders. So labor, product, at capital.
The main fight, economically, was over the split between the value created by labor and the returns demanded by capital.
But the AI ecosystem model, particularly for applications built heavily on proprietary APIs, is dramatically different because the platform, Layer 1, gets inserted before capital even gets its main cut.
How does that work?
Labor still creates the product, but that product, to function, must constantly pay infrastructure rent back to the platform, the landlord, Layer 1.
Through API calls, compute usage, etc.
Exactly. Only after that rent is paid does the remaining value get split with capital. Layer 2, the VCs.
So the flow isn't labor product to capital anymore.
No, the sources map it as labor platform infrastructure rent capital.
Now, the platform has successfully inserted itself as this critical, unavoidable toll collector.
They extract their rent before the investors even take their share. This fundamentally changes the distribution of value.
And it heavily structurally favors the landlord, Layer 1.
This is why, the sources argue, you see so many AI companies, particularly in those vertical plays, that might have impressive top-line revenue.
But their margins are alarmingly thin or even negative.
Because a huge chunk of the profit potential is being systematically siphoned upward as cognitive rent before it can even be counted as profit for the settler or the extractor.
Which brings us right back to the stark reality of those vertical solution economics.
As a settler building one of these specialized AI tools, your only real defense against being completely commoditized by the landlord
Is that deep domain-specific data, those proprietary workflows, maybe some regulatory knowledge that makes it hard for the landlord to just replicate your niche easily.
But that defensibility comes with some serious twin constraints. First, as we mentioned, the inherent scalability limit.
These vertical markets, by definition, are smaller, more constrained.
Which means the total addressable market, the TAM, often doesn't support those massive billion-dollar growth at all costs valuations that Layer 2 VCs are typically hunting for.
So there's a mismatch in expectations right there.
And the second constraint is even more terrifying. It's that existential threat the sources call platform risk.
This feels like the sword hanging over every settler's head in this model.
Absolutely. You are completely dependent on the underlying AI infrastructure, its pricing, its terms of service, its continued availability.
Imagine your business model relies on your core AI inference costing, say, $5 per transaction today. That works. You have margins.
But what happens tomorrow when the landlord, Layer 1, decides their newest, fastest, must-have model now runs on 25 cents per inference, effective immediately?
Or they deprecate the older, cheaper API you relied on.
Your entire business model, carefully built on those margin assumptions, just collapses instantly.
You've effectively surrendered the keys to your own economic engine to a third party.
Your success becomes entirely conditional on the continued benevolence, or at least predictable pricing, of the landlord.
Which, in a ruthlessly capital-driven market focused on maximizing shareholder value for Layer 1, seems like a structural impossibility in the long run, right? Benevolence isn't really the goal.
That's the core argument. It's a fundamentally fragile position.
So to keep the settlers compliant, to keep them building within this fragile, constrained, high-risk system.
The sources argue a set of psychological chains are deployed. Emotional control mechanisms designed to keep everyone focused on the hustle, the execution, not the structural analysis.
The first one is the constant weaponization of FOMO. Fear of missing out.
It's everywhere in the tech narrative, but it feels amplified in AI. It's this perpetual engineered anxiety about falling behind the curve.
If we don't integrate this new model now, our competitors will.
Exactly. You feel pressured to constantly iterate, adopt the latest thing, integrate the newest API.
Even if it introduces massive technical debt or isn't fully understood or might dramatically increase your cognitive rent later.
Because the immediate fear of obsolescence, of being left behind, feels far scarier in the moment than a critical analysis of long-term platform dependency.
Okay, what's next?
Technical illiteracy anxiety. The pressure to participate, invest in, and talk about AI is immense right now across all industries.
But the actual foundational technical understanding, how these models really work, their true limitations, their hidden operational costs, the data implications, it's often quite low, even among decision makers.
This fear, this anxiety about not getting it, creates a heavy reliance on who?
The consultancy-industrial complex we talked about earlier, mechanism 3.
Exactly. You need the priests to translate it for you, to tell you what your AI strategy should be, which of course reinforces their power and their fees.
And the third chain identified is validation craving.
This is the relentless, almost systemic need for external confirmation, getting that pitch accepted by a top VC.
Landing that profile in a major tech publication, getting that speaker slot at the big conference.
It all functions as the system's primary reward loop. It reinforces compliance.
How so?
If you use the right language, operator unfair advantage, follow the expected capital roadmap, vertical play, aim for acquisition, you get validated. You get check the article, the stage time.
It creates this powerful feedback loop that keeps you aligned with the extractor's goals, not necessarily your own goals of autonomy or maybe even just building a sustainable business.
And these psychological levers, when applied consistently, become so effective that they start to solidify into something even deeper. Systemic moral frameworks, beliefs about what is good.
Okay, like what?
Like entrepreneurship itself being framed as a moral virtue. Building businesses, especially high-growth tech businesses, is positioned almost as an ethical imperative, a social good in itself.
Regardless of the actual value created or the structural extraction you might be facilitating for Layer 1 and Layer 2.
The implication is if you're not participating in this race, you're somehow failing society or lack ambition.
That pairs directly with the next one, hustle as identity.
Mm-hmm. Constant, relentless, visible activity, working 100-hour weeks, always being on, is adopted not just as necessary, but as a moral good, a sign of virtue.
If you're sleeping 8 hours, you're lazy. If you take a vacation, you're not committed.
This mechanism ensures the settler is often too exhausted, too caught up in the performance of work, to pause and ask critical questions like,
Is this frantic activity actually creating durable value? Or am I just maximizing the cognitive rent I paid to the landlord while burning myself out?
and the final, maybe most corrosive moral framework, wealth as scorekeeping.
Where financial outcomes, specifically those valuation metrics defined and assigned by the extractor, layer 2 VCs, become the primary measure of human success, worth, and even ethical standing.
Right. Your value as a person becomes tied to your company's valuation, a number largely determined by people whose goal is extraction.
It completely divorces the idea of success from other potential metrics, like true utility, genuine innovation, artistic expression, worker well-being, or even just personal autonomy and creative freedom.
It binds the settler's identity, their sense of self-worth, directly to the metric controlled entirely by layer 2, which is a very powerful form of control. So we've mapped the structure, we've dissected the rhetoric, we've looked at the financial flows and the psychological costs.
Now we get to what the sources call the contextual annihilation matrix, which sounds intense.
It is. It's about applying this broader, powerful, critical frameworks lenses from different philosophical traditions to this entire AI ecosystem we've described.
To expose its deepest ideological flaws, maybe. To move beyond just critique and into a more systemic deconstruction.
Exactly. This is where the specific roles we identified, the landlord, the extractor, the settler, find their echoes in older, deeper analyses of power and economics.
Okay, let's start with lens number 1, the Marxist interpretation. How does that map onto the AI triad?
Well, classical Marxism focuses heavily on the ownership of the means of production. So you map the classes based on that.
So the bourgeoisie, the owners of the means of production, in this context, who are they?
The sources argue it's clearly the VC and private equity firms, layer 2, the extractors. They control the capital means of production. They allocate the resources. They define market value. They essentially own the financial trajectory of the companies they back.
Okay. What about the founders, the consultants? Where do they fit?
They're mapped to the petite bourgeoisie. They occupy this really precarious middle ground.
They own some of the value they create, maybe through stock options, but not the fundamental means of production, the platform, or the ultimate financial control, the capital.
Right. They're constantly negotiating their position relative to the new AI means of production, layer 1, and the capital controlling it, layer 2. And they're always at risk of being pushed back down, essentially proletarianized, if their venture fails or gets acquired unfavorably.
Which leaves the proletariat. Who's that in the AI economy?
That's the broad base of developers, the data labelers, the end users generating the data, essentially. Layer 3 labor in its purest form.
They're generating the raw value, the code, the data, the interactions that ultimately gets captured and monetized by the platform, layer 1, and then distributed according to the rules set by capital, layer 2.
They own their labor power, but they don't own the computational means, the APIs, the models, needed to leverage that labor effectively outside the established structure.
In the Marxist critique of the rhetoric, particularly that unfair advantage doctrine.
It's seen as devastatingly simple from this perspective. Unfair advantage isn't some mystical quality of innovation or hustle.
It's just a polite rebranding of pre-existing capital accumulation and social capital.
Exactly. It's the coded way of saying, we, the bourgeoisie and maybe some petite bourgeoisie, have access to the $100 million seed round, the decade of proprietary data, the connections for regulatory capture. And you, the proletariat or aspiring settler, probably do not. It naturalizes structural inequality.
Okay, that's one lens. What's the second one? The anarchist critique. What does that focus on?
This lens zeroes in on the system's impact on individual autonomy, freedom, and the potential for decentralized, non-hierarchical creation.
And it sees a major flaw in the enforced hyper-specialization that the vertical play strategy encourages.
Right. The intense pressure to find a defensible niche, a narrow vertical, forces creative labor into these incredibly specific, often restrictive lanes.
Become the absolute best AI tool for analyzing left-handed widget defects in turquoise widgets.
Something like that. The argument is that this systematically destroys broader creative freedom. The settler isn't solving interesting, open-ended problems anymore.
They're constrained to highly specific, pre-approved by the market, by the extractor, problems that fit neatly into Layer 2's market models and are manageable within the landlord's platform constraints.
And the most bitter irony from this anarchist perspective is what the sources call voluntary enclosure.
Meaning people are choosing this.
Yes. The settlers are often actively, willingly, even enthusiastically self-selecting into these corporate-controlled matrices.
They're choosing the path of dependency, building on rented land, accepting the rules dictated by Layers 1 and 2.
And they're labeling it freedom. I'm founding my own company. When structurally, they might be entering a sophisticated form of enclosure.
Which is essential for the third point under this lens, dependency creation.
The system, by its very design, especially reliance on proprietary APIs, systematically eliminates the possibility of true self-sufficiency for many players.
If your core product cannot function without paying rent to Layer 1, you are, by definition, dependent. You cannot be autonomous.
Every step forward you take in building out your vertical application is potentially a deeper step into platform reliance, making a future escape to true autonomy harder, not easier.
Powerful critique. Okay, the third lens, the Buddhist perspective. How does that apply here?
This framework looks at the internal experience, the psychological drivers and consequences, using concepts like craving, suffering, and attachment. It focuses on the life of that alchemical entrepreneur we discussed.
So it starts with tana, which means thirst or insatiable craving.
And this concept perfectly captures that perpetual motion, that relentless drive of the typical founder persona promoted by the ecosystem.
It's that deep, unceasing thirst for the next thing, the next idea, the next funding round, the next validation metric, the next rung on the valuation ladder.
Always pushing beyond the current reality, never satisfied with the present state, constantly chasing something just out of reach.
And the inevitable result of that constant, insatiable craving, according to Buddhist philosophy, is
dukkha, usually translated as suffering, dissatisfaction, stress, or fundamental unease.
And this manifests very clearly in the startup world, doesn't it? The high rates of burnout, anxiety, imposter syndrome.
Yes. The perpetual dissatisfaction, even among those who achieve significant financial success by external metrics. The system seems designed to ensure the chase is the point, not the attainment.
You hit that $50 million valuation you were dreaming of.
And immediately, the extractor, your VC board member, is asking about the path to $200 million. The goalposts always move. You are kept permanently in a state of feeling behind, of needing to crave more.
Which is enforced by the final concept here, attachment.
This is about identification. Specifically, the founder's deep identification with the prescribed operator role, or more broadly, their attachment to those external validation metrics, especially the valuation number.
Once your identity, your sense of self-worth, becomes fundamentally tied to that scorekeeping defined by Layer 2.
You are bound to the system's inherent cycle of craving and suffering, tana and dukkha. You prioritize the external, extractor-defined goals over potentially more fulfilling internal goals like autonomy, creative satisfaction, or building something sustainable on your own terms. Your ego gets trapped in their game.
Okay. The deconstruction feels pretty complete. We've looked at the structure, the rhetoric, the money, the psychology, the critical lenses. The system is laid bare.
So now the absolutely critical section. If this analysis holds water, how do you escape? Is there an escape vector from this matrix?
The sources don't just leave it a critique, right? They do suggest a path toward resistance, towards reclaiming autonomy.
Yes, and it focuses entirely on exploiting what they see as the system's single greatest vulnerability, its fatal flaw.
Yeah.
The entire intricate, high-margin extractive structure, the landlord collecting rent, the extractor dictating terms, depends absolutely on the voluntary participation of the creative class, the settlers.
They need people to willingly build within the constraints they've set up.
The system only works if Layer 3 labor continues to accept the role assigned to it. It starts to collapse or at least significantly weaken under two conditions.
First,
if labor refuses the subordinate operator categorization, if they reject the linguistic control and the implied hierarchy.
and second,
If builders, founders, developers consciously decide to prioritize genuine autonomy and creative control over chasing those venture scale returns defined by Layer 2.
the moment the settlers stop valuing the extractor's definition of success, that massive valuation number, as the ultimate goal,
The entire justification for the extractor's control and by extension the landlord's rent seeking starts to falter. Their power relies on our buy-in to their metrics.
So, achieving that requires what the sources call cognitive liberation strategies. Mental shifts first.
The first step is simple conceptually, but requires ruthless honesty. infrastructure awareness.
You have to actively, diligently map all the dependency relationships in your business model. No wishful thinking.
Where exactly do you rely on proprietary APIs? For what percentage of your core functionality? What's your plan B, C, or D if the landlord doubles the rent tomorrow or shuts off access?
You absolutely must know where the keys to your own kingdom are actually held. Who has the power to turn off the lights?
Then, building on that awareness, you have to establish autonomy metrics. Define what success means for you outside the capital-controlled validation frameworks.
So consciously ignore the valuation game dictated by Layer 2 VCs.
Or at least deprioritize it. A true autonomy metric might be something like maximizing revenue per employee, not just total revenue.
Or calculating your capacity for self-funding future growth without needing another venture round. Measuring your runway in terms of profitability, not just cash burn.
It shifts the focus from externally judged capital growth to internal operational health and, crucially, independence.
Okay, awareness, new metrics. What about strategy? How should you build differently?
The sources suggest a strategy of vertical transcendence. This is the opposite of being contained within that single, narrow vertical square that the extractor prefers because it's easy to model and acquire.
So instead of AI for niche legal discovery,
You aim to build more generalized, reusable modules or capabilities that can be applied across multiple, perhaps non-obvious verticals or matrices.
like maybe you build a really robust pattern recognition engine.
And yes, you might apply it first to legal diligence, but you design it from the start so it can also be applied to, say, medical diagnostic imaging analysis and specialized industrial defect detection.
This creates value flows that are less linear, much harder for a single platform landlord to capture entirely.
Because the core value resides in the cross-application potential, the generalizability, not just the deep specialization in one controllable niche. It makes you less predictable, less dependent.
And supporting all this, of course, is linguistic resistance.
You have to consciously reject the controlling terminology. When someone influential calls you an operator,
Politely, or perhaps not so politely, correct them. Use terms that assert ownership and strategic control. Founder, architect, owner.
if you internalize and use their language settler, operator, you are subconsciously accepting the subordinate position they've assigned you in the hierarchy. Language shapes reality.
So let's contrast the two value flows really starkly.
Yeah.
The old way versus the proposed new way.
Okay. The extractive model, the default AI triad model. Creativity gets channeled into a narrow vertical solution. That solution immediately starts paying platform rent to layer 1. And only the leftover value, if any, flows to capital, layer 2, and the founder's employees, layer 3.
Rent comes off the top, always.
Now, the proposed autonomous model. Creativity flows towards multi-vertical integration, that transcendence idea. This allows for more direct value capture by the creators, potentially bypassing or minimizing the layer 1 tolls because you're not locked into one platform-specific niche tools.
And that captured value can then flow towards reinvestment, not just for growth, but specifically for strengthening autonomy, maybe building alternative infrastructure, expanding independence.
The absolute key is strategically removing or at least minimizing the power of the toll collector, layer 1, and the extractive allocator, layer 2, from the primary path of value creation and distribution.
Are there tangible ways to do this? Real resistance opportunities emerging on the technical side.
The sources point to a few promising vectors, though they're still developing. These could challenge the landlord's structural dominance over time.
Like what?
One is a continued development and adoption of federated AI models.
Instead of relying on huge, centralized proprietary clouds run by layer 1.
Federated learning and inference distribute the computational load across many smaller, potentially user-owned devices or nodes. This could decentralize the infrastructure, challenge layer 1's control, and maybe significantly reduce those cognitive rent costs.
Interesting. What else?
Different ownership models. Specifically, exploring cooperative ownership structures like worker-owned AI development collectives.
So layer 3, labor would simultaneously own the capital and the means of production.
Exactly. It structurally dismantles the triad from the inside by merging the roles, ensuring value flows back to the creators directly.
And technically.
Finally, a strong push for open protocol development, creating robust interoperability standards for AI models, data formats, and even cloud infrastructure.
If you could easily swap out the foundational LLM you're using or move your workload between different cloud providers using open standards.
You dramatically reduce that platform risk, that lock-in. You regain bargaining power against layer one. You're not existentially dependent on one vendor anymore.
So it really comes down to a critical choice point for anyone building in this space.
Seems so. You can accept the default Itrix position, follow the vertical strategy, court the extractors, pay the landlord's rent. It offers a somewhat structured path, maybe faster initial funding.
But it comes with that high probability of value extraction and long-term platform dependence. You're playing their game.
Or you can consciously reject that vertical containment, which means embracing higher uncertainty, probably a harder path initially, definitely requires redefining success away from just valuation.
But holds the potential for genuine autonomy, for building something resilient, independent, and maybe ultimately more fulfilling, where you control the value you create.
Which brings us back full circle to the fundamental paradox we started with.
That this AI revolution, so often framed as pure liberation and democratization,
Might actually be a highly structured corporate roadmap disguised as liberation.
So the synthesis of all this analysis, the takeaway from these sources, it points towards a new final metric, a different way to measure your success.
Forget, or at least heavily discount, measuring your position purely by valuation or even top-line revenue. Those are metrics dictated by the extractor, the entity that ultimately aims to own your output.
Instead, the real measure of freedom and resilience in this emerging economy is different.
Measure your position by your distance from infrastructure rent. How much of your value is siphoned off before you even see it? How dependent are you?
And perhaps even more importantly, measure your capacity for autonomous value definition. Can you decide what success looks like, or are you forced to adopt the metrics of layer 2? That's the real score.
And that's our deep dive for this week.
Remember, the most dangerous illusion is often the one you don't know you're in.
But maybe now you have a clearer map. So here's our question for you, the listener.
So we've torn apart the AI entrepreneurship narrative, or at least presented a critical view from the sources. Now, the real question is, what is the one idea you've held on to, maybe about AI or startups or success, that you're finally ready to put on the chopping block?
Let us know. We're genuinely curious.
Question the narrative.
Deconstruct the dogma.
See the system.
We'll see you next time. Stay skeptical.